Hi, everyone. Today I had the opportunity to speak with portfolio manager Ben Jang, and specifically, we focused on our public market strategies. I really like this discussion because Ben provides us with an overview of how we performed in 2022, what we see in 2023, and how we're positioning in those funds for the current market environment. What really struck me about this conversation is that it brings up the old debate of active versus passive strategies. It's always been the case that we have been active managers with a value focus and a lean towards cash flow oriented investments. Ben does a really good job of explaining how, in the current market environment, it's necessary to take that active approach and be tactical in the pursuit of alpha. I hope you like this discussion as much as I did. Hey, Ben, thanks for joining us today.
Hi, Ethan. Great to be here.
Maybe we can jump right into it. When we communicate about our returns, we often cite the Nicola Core Composite. Can you explain to our viewers what is that? And how would you describe the path and our success in that core composite?
Yes, so the core composite is actually uh, a collection of realized returns from clients who follow our core model. So it encapsulates everything the client experiences to achieve those returns, including um, their specific asset mix, although it should be very close to the core, and all the fees that they pay as well. So it really is a representation of the achieved returns our clients experience and have experienced historically. In terms of achieving those returns, we like to think of it as the sum being greater than the parts. And what I mean by that is we've highlighted the exposure we have to alternative asset classes, going beyond stocks and bonds. So we have exposure in real estate and we have exposure in private markets. But achieving a return for clients also means how have they done in terms of rebalancing? And also for each individual asset class, how have the returns of that asset class been in relation to a benchmark or a peer group? So we take a look at all of that, and that's how we achieve superior returns or how we achieve our historical returns for clients. And if we take a look specifically on the public side, we take a look at 9 public funds across 1, 3, 5-year time horizons. We do have one fund that hasn't yet quite reached its 5-year anniversary mark. So we have 26 data points. In those 26 data points, we've achieved 21 first quartile returns, and 24 out of the 26 data points, we are either in the first or second quartile. So relative to our peers, we've done quite well.
Thanks for that. Really interesting to know that what we're citing is actually the experience our clients get on an after fee basis. And also very interesting that our active style to management is ranking as high as it is. You mentioned our public market investment strategies. Can you talk a little bit about what yardsticks you're using or you're most focused on when you're measuring performance as well as risk?
Yes. When we take a look at the public side of things, we have quite a differentiated approach to investing. So there are indices out there, obviously. So for example, in the Canadian equity market, there's the S&P TSX Composite. Now, we're very familiar with that index, but unlike other managers, we're not completely focused on the benchmark. We are benchmark aware, but not focused. And oftentimes, our view is it's difficult to differentiate your returns from the benchmark if your holdings don't look different from the benchmark. So when we do that, our differentiated approach allows us to take different types of positions and active bets than some of our competitors, and that's allowed us to achieve differentiated returns. Now, when we measure performance and we measure risk, because a lot of competitors are focused on indices, they think about risk as really how close are or far away are they from the benchmark. We view risk differently. We view risk as the potential for either a permanent loss of capital or volatility. And there's other ways that we look at risk, but those are the two predominant ways. So when we take a look at that and risk from that perspective, that is one of the reasons that has allowed us to achieve strong returns relative to our peer group. So here on this slide, we're taking a look at our public equity returns relative to peer groups, and we can see across the Canadian equity, US equity, international, global, and sustainable, our relative returns from a percentile basis versus peers. So 100 percentile is really the highest we can be, and would be ranked number one versus peer groups. And this peer group is actually quite widespread. So for example, we've had about 180 peers or competitors for the Canadian equity market and about 2,000 or so for the US market. So really broad-based. And if we take a look on the fixed income side, we can see a similar story. We can see that the fixed income side, we rank quite favorably as well to our peers. We can see that within the bond fund, for example, and high yield fund, we're ranking 95th or 99th percentile versus our peer group. So very strong historical returns.
Thanks for that explanation. Great to see the rankings. Maybe you can talk a little bit about, 2022 and the outlook going forward. It was a very difficult year for both stocks and bonds and public market investments in 2022. What do you see going forward?
Yeah, so it was extremely challenging environment for the public markets, both on the equity side and the fixed income side last year. And we have to go back to the reason behind that. And the reason behind that is interest rates. If we take a look at interest rates, we can see that it rose significantly during that period to the point where it was, this is to the end of last year, but we're closer to 5% now. And really, if we go back for several decades, we were in an environment where we saw interest rates declining for 4 decades, where we made lower lows for interest rates over 4 decades. And last year was a violent reversal of that trend. And so what we saw last year and what we're seeing in this year and for the coming future is the ramifications of higher interest rates and the impact it has on both fixed income and equities and really the general economy overall. So if we take a look at what's occurred, we've had higher inflation, which has led to higher interest rates. And the reason behind that in terms of the central bank is that they want to increase the cost of borrowing and thus decrease demand for goods and services. And if you think about something like a car where there's additional cost for a loan or a mortgage for a house, that's the goal, is to reduce demand. And the ramifications of high interest rates are very far reaching. So when we take a look at this year and the coming future, that's what our focus is on. Now, if we take a look at what the high interest rates means, it does create an environment where it's a bit challenging. And so we do view that there is a probability or likelihood of a recession coming in the future. And so we're prepared for that recession in both how we're positioned in fixed income and equities and looking for the opportunities that brings about. I should also note that when we think about Canada versus the US, there is a dynamic that's playing out that's quite interesting. If we take a look at pre-Great Financial Crisis, the US consumer was considerably more indebted than the Canadian consumer. And then during the financial crisis, the household debt for a Canadian consumer and a US consumer was virtually the same. But since then, the debt for a Canadian consumer versus a US has deviated, whereas the household debt for a Canadian now is significantly higher than our US counterparties down south. And so what that means from an investment perspective is there are higher interest rates now in Canada and the US, but there's a likelihood that Canada will cut interest rates or be earlier into reducing interest rates versus our counterparties in the south, because of the indebtedness of the Canadian consumer.
That's really interesting to understand the difference and what to expect from the Bank of Canada versus the Fed. So, with interest rates at this elevated level now, what asset classes does this environment benefit?
Yeah, definitely. If we take a look at higher interest rates, what this means is for fixed income, it means higher yields for fixed income. So previously, when we saw interest rates at effectively zero or extremely low, investment grade bonds were paying about 2% and high yield bonds were paying about 4%, and preferred shares were paying about 5%. But since then, since we've seen interest rates significantly higher, investment grade bonds are paying 5 to 6%, and high yield bonds are paying 8 to 9%. So we're constructive on fixed income because of that. Now, when we take a look at our relative returns in fixed income, we can see this chart here helps illustrate how we've done compared to our peer group. And this also we can talk about in terms of the environment that we're in. So this is our bond fund relative to the Canadian universe over multiple time periods. And the bars here of different shades of gray represent the first, second, third, and fourth quartile. Now the top of the bar is actually at the 5th percentile, and the bottom of the last gray bar on the bottom is the 95th percentile. As you can see, we've significantly outperformed our peer group, and this is actually 1,400 peers or 1,400 competitors across all of these time horizons. I think it's also interesting to note that when we take a look at the benchmark, the iShares Core Canadian Universe Bond, that is done reasonably well relative to funds. So there's a few things to gain from here. The environment for passive versus active investment, we believe it's changing, but historically it's been a little bit more challenging for active investors. Despite that, we've significantly outperformed our peers, or the majority of our peers. And number two, when we take a look at the absolute return aspect of it, you can see here that the returns historically over the past 10 years for bonds have been relatively muted. And this is because of low interest rates. When you think about fixed income investment, there's really two key components to return drivers: where interest rates are and where credit spreads are. And credit spreads compensate a fixed income investor for taking credit risk or the risk of their investment or the company going default. Now, what we're seeing in this environment is interest rates being significantly higher creates a much higher base rate for fixed income investment. So we believe that there's a much higher return possibility for fixed income in the coming future. And we believe that that environment allows us to be active in our approach, and hopefully because of that, we can continue to achieve our strong relative performance. If we continue on and take a look at high yield bonds, we see a very similar dynamic. We see that relative to the peer group, and this is 682 peers here, that we've done quite well relative to those peers, and a similar dynamic in terms of the benchmark. And here it's the iBoxx High Yield Corporate Benchmark, where it's done well relative to active managers. So we think again that the environment is changing where it's a little bit more beneficial or will be more beneficial for an active manager versus a passive manager. In addition to that, the base rate or level of interest rates being higher means that there will be a potentially overall higher potential for return, with yields being higher than they have been for quite some time.
That's a great rundown on how the environment lends to opportunity for the fixed income investor. Can you talk a little bit about how high interest rates will impact equities?
So when we think about equities, they're on the flip side of debt. And what I mean by that is when we have high interest rates, it's higher yield for bonds. But on the flip side, it also means that there's a higher cost of debt for companies. And that impacts earnings, and because of that, it impacts equities and stock returns. If we take a look at earnings and how the market has perceived earnings revisions, we can see that this line, which is an average of earnings revisions lower over the past few years, has proceeded. And that is, it's generally sticky on the upside before analysts see that there are concerns and they want that to reflect in their numbers, and then they start to downgrade earnings a bit more aggressively. And that generally takes about 16 months to transpire. What we've seen so far is something similar. So we've seen earnings being a little bit sticky to the upside, and we do think that because of the macro environment, because of higher interest rates and the higher cost of debt for companies, that this will likely weigh on earnings, and earnings are likely to be revised lower because of that. Now, that being said, if we take a look at now active management, right? So in that environment where we've previously been in with low interest rates, it's really been an environment where it's impacted growth companies, and it's also been an environment where it's been more difficult for active management. And what transpired in 2022 was actually it was one of the best years over the past 15 years or so for active management. So 61% of active managers actually outperformed their index. And we can see here the line for 50% that, again, it's been a little bit of a struggle over the past 15 years or so for active managers. But with higher interest rates impacting equities, impacting earnings, we believe that the environment is changing and there's a likelihood that we'll be able to add value. So yes, higher interest rates are negative for earnings, but to offset that, I think that our ability to take a look at the environment, our ability to be active managers is increasing, and that helps to offset some of the risks that we see in terms of earnings.
That's really interesting, and it makes me think of a recent conversation you and I had actually, where we talked about an earnings recession. And since a recession is something of concern, you know, can you speak a little bit about how this might impact the way equities perform and our positioning?
Yeah, so I think it's important to note when we talk about a recession, so we believe that there's likely a earnings recession coming, and there's a likely chance of an economic recession. But the severity of that really drives our positioning and how we react. Higher interest rates likely will lead to that recession. But when we take a look at the real economy, one of the things that we look at is the employment rate. And when we take a look at employment or unemployment, and we take a look historically, we're at 3.6% here. And yes, it spiked about 13% during COVID, but 3.6 is extremely low. And if we take a look historically and what that means, we can see that 3.6 is actually, it's one of the lowest levels for unemployment for the past 50 years. And it's difficult for me to imagine a significant or severe economic recession when the unemployment rate is that low. You see, part of the Fed situation is to manufacture a soft landing, they would like to see prices or demand for goods and services be reduced. In order to do so, they would like to see an environment where wages or wage growth is muted, and yet unemployment does not spike significantly higher. But since unemployment is so low, there is an opportunity for it to creep higher without really being overly impactful to the real economy. So because of that, yes, we do see a recession, but we don't think it'll be an overly severe recession. And another thing that we're tracking is really positioning for the marketplace. If we take a look here, this is from Bank of America, and it's a survey of asset allocators. We can see that the asset allocators have really changed their positioning at the beginning of this year. And 60% of allocators are now underweight equities. So again, when we take a look at the probability of recession and then the impact on the equity market, it's difficult to imagine a severe correction in the equity market because generally to see that severe correction, it's due to people being crowded. And as people have already reduced their overweight in equities, we are not seeing that kind of crowded positioning. One thing I would also note is when we take a look at the volatility in the marketplace, so we do believe that because of an earnings recession and an economic recession, we are going to see more volatility. That does not necessarily translate to a large realized annual returns being lower. We can see here that volatility can show in terms of intra-year drops. So we've seen drops of 30% or more a few times. But here we see the actual returns for years for the stock market. And as we can see, in some environments, we saw large intra-year drops and still positive returns for the equity market. And so we think it's prudent to still remain invested in equities, but what we've done is we've been a little bit more active and tactical in our positioning. So as things come on sale, as we can see here in the 80s, in the mid-late 80s, we saw a 34% drop. And so we're reviewing all the names that we like and all the companies that we like, and it just allows us to buy things on sale. And if you stick through the long haul, you'll see that the returns here, there's a higher likelihood of achieving positive returns. And with our tactical nature, our goal is to provide added value or alpha to those opportunities as well.
That's a really interesting analysis, and I really like that chart showing how in some years you had a big drop, but still a positive result. Maybe we can cap off one final question, Ben. In times of economic uncertainty or challenges or distress like we're seeing today, how do our strategies, how have they historically performed?
Yeah, so just to kind of recap, in terms of equities, uh, we think that we won't experience a severe correction in the equity market, but there's a likelihood that we'll experience more volatility. Over the past 10 years or so, we've seen a little bit more muted volatility in equity markets, and we think that's going to change. We think that there's going to be more enhanced volatility in equity markets, and maybe returns might not be as robust. And so we have different strategies to benefit from that type of scenario. But also when we take a look historically, how we've returned during those types of environments, what we did was we took a look at when the index returned between -2 and 2% in a month, and how our funds returned relative to the index during that type of environment. And as we can see here, for fixed income funds, this is graphing our bond fund, our global bond, high yield, and preferred share versus a comparative index. When the index has been that kind of in that situation where returns have been more muted, our returns have generally been higher. And so this is due to our active positioning and our tactical views. And we see a similar story as well from the equity market when we compare to the index during those time periods. Again, those time periods where the monthly returns are kind of muted, but we see more enhanced volatility, that allows us to be more tactical in our approach. So we still think it's prudent to remain invested. Currently, we're a bit more defensive in our positioning, but we have different playbooks for transitioning between defense and offense and back and forth depending on the market environment. And our belief is, given the enhanced volatility, we'll likely be in that situation for quite some time where we think it's prudent to remain invested, but we need to be quite nimble in our approach to achieve those enhanced returns or achieve alpha.
Ben, that was great to hear about how we have a very hands-on approach in an environment like this. And thanks overall for your insights and digging into it today. We'll look forward to the next discussion with you next time.
Thanks, Ethan.